Today on Ag News Daily.
What is the cow-calf producer's confidence in profitability going forward? Because we have to think about this a little bit differently than we do a grain producer, where they're planting a crop and harvesting it annually, or even a pork or poultry producer, where their production intervals offer them opportunities to have revenue readjustments multiple times a year.
Why are you laughing already?
I'm just laughing because the prompter is crooked.
It is. It's my fault. But welcome back to the weekly edition of the Ag News Daily Show. This is our last one. This is our last one?
This is our last one. You didn't dress up in Christmas. I wore my Christmas
I dressed up. I
everything.
did my hair today.
You did. I will give you credit for that.
Well, right now, December has added to some of the soil moisture problems. Deficits are still under in the Midwest snowpack region, but we're expected to see some of that change now as warm air moves in. A strong ridge building over the central U.S. will bring warmer temperatures through Christmas. I'm kind of sad about that. Possibly into the end of the year as well. We're going to see snow melting, which will recharge some of the topsoil moisture across much of the Midwest. Brief shots of cold air are still possible later this week, but they look to be short-lived. Meanwhile, our friends in the Plains and Delta and Mid-South region, as well as the Southeast, will remain mostly dry. About two-thirds of the continental U.S. right now is still in some aspect of drought. Eric Snodgrass with Nutrient Ag Solutions predicts that the drought will drop below 40% by May, though. We're looking at warmer than normal conditions that will continue across the central and southern plains, raising concerns for winter wheat. Dry soils and early warmth could wake that wheat up from dormancy, reducing winter hardiness before colder temperatures return later in the season. I don't know if I'm all right with green grass at Christmas time.
I know. There's something nice about white Christmas. My husband and I were just talking about that yesterday, but that's not in the cards this year. Switching tracks, the U.S. House of Representatives overwhelmingly passed the Whole Milk for Healthy Kids Act of 2025 earlier this week, giving schools the option to offer flavored and unflavored milk and whole milk and 2% along lower fat choices. It's now awaiting President Trump's signature. The bill amends the National Schools Lunch Act, but does not mandate whole milk. It restores flexibility for school districts to choose. The bill author, Congressman G.T. Thompson of Pennsylvania, said whole milk is an important part of a balanced diet and students should be able to choose the milk they enjoy. Dairy groups say that the change could also boost demand for butterfat, supporting farm milk prices at a critical time for producers. Once signed into law, USDA's Food and Nutrition Service will issue updated guidance, and local school districts will decide if and when to add whole or 2% milk back to menus, potentially as soon as the new semester. When whole milk was removed from schools back in 2010, students pushed back, and a study by the American Farm Bureau Federation found milk consumption actually dropped sharply, with declines rising as much as 77% in schools. Tanner?
I don't remember ever having whole milk as an option.
I do. It was a red carton. I remember it.
You know, you might be right, but it's good to see some positive headlines for our dairy producers. The USDA's Animal and Plant Health Inspection Service has confirmed highly pathogenic avian influenza, the HPAI, in a Wisconsin dairy herd, marking the first known detection of HPAI in cattle in the state. USDA says the finding does not change its eradication strategy and continues to stress biosecurity as the most important tool to prevent transmission between farms. Federal agencies emphasize that there is no risk to consumers, pasteurized inactives in the virus, and the commercial milk supply will remain safe. This is the CDC also noting that the public risk is low. Since early in 2024, HPAI and H5N1 have been confirmed in over 1,700 dairy herds across at least 18 states. California, Idaho, and Colorado reporting the highest numbers. In northern Indiana, the virus continues to impact commercial poultry, and new detections at 2 meat duck operations and 1 egg layer facility, leading to depopulation of more than 46,000 birds. Control and surveillance zones are in place, and expanded milk testing is underway to monitor herd health across those states that have these reports.
Well, we're going to keep in line here with the bird or poultry flu stories, a bipartisan group of 23 U.S. senators is urging the USDA to speed up the development of a comprehensive bird flu vaccination strategy as we see HPAI continue to spread through poultry flocks nationwide as well. Lawmakers say that HPAI has killed millions of birds, adding strain to producers already facing tight supplies and volatile markets. While USDA announced earlier this year it would pursue a vaccine, senators say farmers still lack a clear timeline or framework. They stress any vaccination plan must be science-based, include input from producers and veterinarians, and carefully consider potential impacts on international trade. So a quick update to that headline there. But, surprisingly, even with that continuing, egg prices at the grocery store have not been exponentially high compared to where they have been.
Yeah, it is interesting to see how and where that will shift, especially as we see birds migrate, is leading to a lot of that spread. Well, the United States and Mexico have reached an understanding to meet water delivery obligations under the 1944 Water Treaty. They're addressing both the current cycle and the previous water deficit impacting southern Texas farmers and ranchers. This was announced this week in a press release that came out last week. Under this agreement, Mexico will release 202,000 acre-feet of water to the United States, with deliveries beginning reportedly this week, and negotiations are underway to finalize repayment of the remaining deficit by the end of January 2026. The USDA says this move brings much-needed certainty to producers planning for the upcoming growing season. U.S. officials credit this agreement with holding Mexico accountable after years of shortfalls that caused severe water shortages in the Rio Grande Valley, damaging crops and other local economies in that area. Under the treaty, Mexico is required to deliver 1.75 million acre-feet of water to the U.S. over a 5-year period, while the U.S. delivers 1.5 million of acre-feet to Mexico from the Colorado River. Federal leaders say cooperation will continue, but warn the U.S. reserves the right to take action if Mexico fails to meet its commitments going forward. It's hard to fathom what acre-feet of water looks like.
Exactly what I was just thinking as you were reading through that, Tanner. But water is a top concern across agriculture in particular. And at the recent National Association of Farm Broadcasting convention, where Michelle and I were attending, leaders from around the country shared their challenges that they're seeing in their specific states. First, we heard from a Southwest farmer sharing what local producers are facing in her area.
Kansas, the water is owned by the state of Kansas, and you are permitted your permitted water. So it's an allotted water acre feet per well. And so we had right about 16,000 acre feet all together. And we said we're going to cut back 22% within a 5-year period. If we go over the 22%, we get to bank that water. And that way, if it's over a 5-year period, you can use it the next year if you have a drought or whatever. I mean, again, it's a volunteer program, but yet it's also supposed to work for you, the agriculture farmer. And so we went into it. Just simple things we did. We used more technology. Our biggest thing that we have is sitting on the aquifer is number one. I believe that water is undervalued. It's under quantitied and it's under qualitied. We're facing all three things. And there's areas that have really done their share and done a lot to save on water.
Now let's hear from Texas, where farmers are dealing with their own unique water issues.
The issue there is in those areas where they're depleting it. They're trying to make the decision right now. Do they try to dry land farm? Or do they just let it go back to grass and start raising cattle? The other issue in the Panhandle is that a lot of dairies have moved into that area from California and from Central Texas, actually. They've kind of gotten run out of Central Texas. And they crop all the time. And so some of those areas are seeing a lot of groundwater declines, even though they wanted the dairies back in the day. Now they're seeing really severe water declines because of the water that the dairies use.
Thanks for that interview. We saw some major changes to the 45Z clean fuel tax credit. that are now set to take effect at the end of the month. An ag economist said the ethanol producers stand to benefit significantly from these. The University of Illinois economist Scott Irwin said the passage of the federal July reconciliation package means a typical Midwestern ethanol plant could receive about 11 cents per gallon starting January 1st, even without investments in carbon sequestration. Irwin also told Brownfield that this boost could translate directly to, or roughly to, 32 cents per bushel in stronger corn bits. He says Corn Belt farmers near ethanol plants should be asking now that the new revenue will be, how that new revenue will be shared. Overall, Irwin estimates the updated 45Z credit could funnel as much as $2 billion a year to the U.S. ethanol industry. Some more to come there, but a little update for our listeners.
We're slowly making progress on that. I'm sure Mitchell Hora is watching on pins and needles. One thing this week, though, that came out from the state of Iowa Secretary of Agriculture Mike Naig announced that the Renewable Fuels Infrastructure Program Board approved 108 projects during their December 17th meeting, supporting new and expanded biofuel infrastructure across 46 counties in Iowa. The project totals nearly $4.6 million, including about $4 million for 93 ethanol projects and $600,000 for 15 biodiesel products. The cost share funding helps fuel retailers upgrading pumps and storage, giving drivers greater access to lower cost, cleaner burning fuel like E15 or unleaded 88 and biodiesel. Secretary Naig said, quote, "These investments make it easier and more affordable for Iowans to choose homegrown fuels." That's an interesting angle to take, Tanner. I don't know if I've ever heard that one before. But since 2006, the program has invested nearly $70 million, matched by roughly $280 million from local fuel retailers. The funding will also help stations comply with Iowa's E15 access standard, requiring most retailers to offer E15 by January 1st of 2026. So should see more pumps with E15 or E88 at the gas pump.
I feel like we already do here in Central Iowa. We also got an update from the Farm Credit Administration. We received its quarterly report last week on the economic conditions in agriculture. There was an update on the farm credit system's performance as well. Despite a turbulent year and tariffs and trade challenges, the U.S. economy is expected to finish 2025 on a relatively stable note. In the farm sector, producers faced a mixed picture of bumper crops that have created marketing challenges amid tight storage and shifting trade, while low commodity prices and rising fertilizer costs are squeezing grain and soybean margins. At the same time, strong livestock prices and low feed costs are boosting the profitability that we hinted at earlier in livestock operations. Farm liquidity and solvency still remain relatively strong, but ongoing low and negative returns for grain producers could weaken financial resiliency as we head into that 2026 loan renewal season. The Farm Credit System reported solid results through their first 9 months of 2025, with modest loan growth continuing across the sector. So kind of read between the lines there a little bit. We haven't finished out 2025 in that report, and modest loan growth could mean additional borrowing.
Absolutely. But we're going to see some additional dollars pumped into those producers affected by Hurricane Helene. USDA Secretary of Ag Stephen Vaden announced $38.1 million in additional USDA assistance to help Tennessee farmers recover from Hurricane Helene, announced via a press release late last week. The funding comes through a block grant agreement with the Tennessee Department of Agriculture and will support infrastructure and timber losses, as well as future economic and market setbacks. This effort is part of the $30 billion disaster relief program authorized by the American Relief Act of 2025. Deputy Secretary Vaden said the funding ensures farmers have the resources needed to maintain a safe and reliable food supply, while Tennessee Agriculture Commissioner Andy Holtz highlighted the partnership between USDA and the state in addressing the unique challenges of Hurricane Helene. Additional program details will be available through the Tennessee Department of Agriculture website for eligible producers.
Well, it is the holiday season, and with more holidays approaching, before we hear from today's conversation, we found something interesting that the new AARP survey, Delaney, I'm sure you've gotten your AARP card.
Not even close, Tanner.
Sorry. AARP found that 89% of U.S. consumers were targeted by fraud this past year, and scams will spike during this holiday season. Gift cards, charities, delivery, and online shopping schemes are the most common. Of course, digital scams are also on the rise. 3 out of 4 consumers used apps like Cash App or Venmo in the past year, which is up 70% from last year. And nearly 40% experienced fraud after buying something through social media. Meanwhile, 1/3 of gift cards were tampered with, allowing scammers to steal funds immediately. Survey results showed that a major knowledge gaps, with only 27% of respondents answering 7 or more questions correctly about safe financial practices. So be alert, listeners, during this holiday season and always, to make sure you keep yourself safe.
Absolutely. But joining us for today's episode is Lance Zimmerman, the senior beef economist with Rabobank. We'll hear his outlook for the cattle herd in 2026, including trends in rebuilding and total inventory, what demand looks like, and a regional perspective on the beef market. Well, we're going to be chatting all things beef and the outlook here for the herd in 2026 with Lance Zimmerman, a senior beef industry analyst with Rabobank. Lance, thanks for joining.
Thank you. Appreciate it.
Lance, before we get into it, tell us a little bit about your role as a beef industry analyst. What are you focused on?
Yeah, anything focused on the beef industry, from cattle production at the cow-calf level all the way to the end user, mostly obviously within the United States, but I do cover Canada and Mexico as well. So Rabobank's unique in that we lend to both boots on the ground ranchers all the way to the restaurant, food service, retail chains. So it's a fascinating role to serve in.
Well, I imagine you've had a very fascinating last year plus, with some of the factors going on right now in the beef industry. Let's start big picture here. When we think about the cattle sector and what it looks like as we head into 26, especially when it comes to rebuilding and total cattle inventory, what is your outlook?
Yeah, there's been a lot of discussion right now about, per capita supplies and cow herd declines and record high prices. A lot of noise magnified with a lot of those discussion points hitting Washington, D.C. even in the last 30 days. What's important for producers to know is, yes, the cow herd's been in decline since the highs in 2019, but we really hit the brakes on cow herd liquidation last year, and that continued through this year, where our culling rate is the lowest it's been of existing beef cows since 2015. And so we hit the brakes on herd liquidation. Now we're kind of looking ahead to what's heifer retention look like on those farms and ranches. How many heifer calves are they keeping back instead of selling so that they can rebuild the herd? And as we look at that, heifer retention, we're kind of dipping our toe in 2025. But really the bigger activity in terms of herd rebuilding from that perspective is likely not to happen until we look to 2026 and basically this time next year, and then 27. And at that point then we'll be off to the races, but not nearly running as fast as a race as we did during the last rebuilding cycle. I would say a lot of producers are thinking back to the previous cattle cycle price highs of 15. Today I would say we're actually a lot closer to where we were in herd rebuilding, where we were in 2013. So we're dipping our toe in that area, but we're not really leaning aggressively into it just yet.
So thinking about rebuilding and heifer retention, what are some of those indicators you're going to be watching for that we are in fact on the right path?
Yeah, I think the first thing we got to keep in mind are the 2 principal axioms that influence heifer retention and herd rebuilding are the cow-calf producers across the U.S.'s major cow-calf producing regions profitable? And then are they in a situation where they have good green grass and forage availability around them? And we can check both of those boxes off with enthusiasm right now. But I do think there's a third consideration that's become more prevalent over the last 10 years of market volatility. And that is, what is the cow-calf producer's confidence in profitability going forward? Because we have to think about this a little bit differently than we do a grain producer, where they're planting a crop and harvesting it annually, or even a pork or poultry producer where their production intervals offer them opportunities to have revenue readjustments multiple times a year because they have a shorter production window. A heifer calf retained this fall is not producing beef that replaces her production until September of 2028. Additional production beyond her replacement isn't coming until September 29. And so a lot of these heifers that are being retained with the idea that they'll be productive members of that cow herd for 5, maybe even 10 years if all goes well. And so it becomes much more of an investment decision. And I think where we are today, that's probably the biggest stumbling block. When we see as much market volatility as we are, it shakes the producer's confidence that, hey, we can retain this heifer and ensure some profitability. Now, as I said, I think supplies will be tight enough that certainly for the next 2 years, prices can be in an uptrend. And I think the slower, steady pace of this rebuild will allow producers to still have a very profitable female in that herd as a new herd replacement well into the end of the decade.
Okay, so as we think then about 26 and 27, rebuilding may not happen fully until a couple years out. Correct. What does that mean for prices? Does that mean we're going to see elevated prices for another 2 years?
Yeah, it really does. One of the things that I alluded to in here is we have record high prices already across all classes of beef and cattle prices. But what gets lost in the discussion is per capita supplies have been flat. They've been between 58 and 59 pounds per person. Going forward, especially next year, we're going to see per capita supplies adjust lower. And again, demand has been at highs we haven't seen since my lifetime began, 40 plus years. And so strong demand with finally declining per capita supplies due to limited cattle imports from Mexico, leaning into that heifer rebuilding story, is going to lead to per capita supply declines that we haven't seen yet. And so we'll see those in 2026, 2027, and maybe even 2028 before we start seeing that additional beef production from a growing cow herd offset some of those declines.
What does that mean for consumer consumption and demand?
Yeah, obviously the reason the beef industry's dominated mainstream media headlines over the last month is because the current administration in the White House is really concerned about record high beef prices. But one of the things I would mention, and I think this isn't lost on your audience, is prices are always relative. They're not static, and you can't look at them in isolation. What I mean by that is, yes, consumer beef prices are record high. But again, it was because of demand, not supply destruction. The other part of this that's important is consumer incomes are not static. Consumer incomes go up and down. And if you look at beef prices and you actually look at them relative to income and convert prices from dollars per pound and instead look at it as how many minutes did I have to work to pay for that pound of beef, the middle American today has to work 15 minutes to pay for a pound of ground beef.
I'd take that.
Yeah, and that's a good trade-off. And in fact, that's very consistent with the 5-year average. It's actually below the high we saw during the pandemic when meat cases went empty and beef prices went through the roof. Back then, it took about 16 minutes to pay for a pound of ground beef. And likewise, during the previous cattle cycle highs in 2015, when we set long-established record high prices that lasted multiple years, it was higher then than it is today. And so, yes, beef prices are higher, but relatively speaking, in light of incomes, there's still a value for the consumer because, yes, it's expensive, but the consumer says it's worth it. And I think that's what's most important in this discussion is this has been a demand-led rally. And so that means the consumer has some room to grow. And our biggest concern should be if consumer incomes shirk back, because then that likely means we're entering into a recession. And historically speaking, recessions are really the only thing that has forced food prices lower for a sustained period of time.
And so, assuming we don't see income shirk back, as you mentioned, are we going to continue to see demand for all cuts or more valued cuts like ground beef or, steak? Where's the balance there?
Oh, it's really fascinating. One of the things, especially in light of all these discussions around domestic beef production and imports and all of those different dynamics that I always remind folks about is beef's different than a lot of other ag commodities. My two examples are always beef is not corn. We buy number 2 yellow corn, and that's what trades all around the states. Bananas. You go to the grocery store, you're pretty much just buying bananas. Your choice is, do you want organic or all natural, or do you want conventional? And that's about the decision set that you get. When you buy beef, to your point, are you buying ultra high quality Wagyu? Are you buying USDA Prime? Are you buying just ground beef or steaks? Or are you buying something out of the frozen section? And so when we talk about beef, you're exactly right. For some consumers, there's more trading happening within the segment than in and out of the segment. In fact, what's fascinating is the beef industry focused on growing marbling and focusing on higher quality genetics. What's happened statistically is in a lot of the academic research, the substitutability of beef relative to pork and poultry has declined. In other words, the consumer said, well, beef's kind of this different beast over here. And so even if beef prices go up relative to pork and poultry, I'm still kind of going to buy my beef. Now, it's fascinating as that's developed over time and that substitutability's eroded, the income effect on beef prices has gone up. And what I mean by that is kind of tying back to our previous discussion. If beef prices go up, but consumer incomes hold steady or even increase, they'll still buy beef. The biggest risk is if beef prices go up and incomes drop. Then the consumer says, I got to do something else. The other thing that's really fascinating about beef prices, we talk a lot about retail beef prices, but I think the consumer also recognizes is post-pandemic, they get a pretty good beef value at the grocery store compared to what we've seen 10, 20 years ago. The pandemic forced a lot of high quality beef into the retail chain because our white tablecloth restaurants were closed.
Yeah.
You went to a lot of Costco's and Sam's Clubs and places that are just kind of known for good beef, but not exceptional. They were offering USDA prime ribeyes and strip loins. And what you notice today is they've stayed in those.
I was going to say, we buy a beef when we can, but we just recently ran out of steaks and we went to Costco and they had great ribeyes.
Yes.
And that we were shocked that the price was reasonable, the marbling was thick.
Yeah.
So I can attest to that.
So the pandemic, one, afforded retailers the opportunity to get access to product they never had. And more importantly, when the restaurants reopened, the retailers said, no, we want that here too. Because our consumer recognized the extreme value they were getting at retail. And so to your point, earlier this year, I was in a Costco, and basically you could buy 4 USDA prime ribeyes that were beautiful, that anybody'd be proud of serving to their guests for $25 a steak. And at first you may be going, oh my gosh, that's a lot. That one steak at $25 at a Del Frisco's or a Ruth's Chris or
close to it,
$75, $100 for just the steak, and then you're buying sides, you're buying a drink, and then you're paying a 20% tip if you like your waiter. All of a sudden you're walking out of there for $130 for a meal you can prepare at home with beautiful sides, a great drink, and good company for $35 a person.
Yeah.
That's a pretty good deal.
It is a great way to look at it.
Yeah. And so relative pricing, I think, is how we need to look at some of these things instead of in isolation.
Let's talk about some of the relative pricing we're seeing in more regional markets to take it back to the rancher. Nationally, we're seeing record high prices across different commodity markets, obviously. What about regionally? What are we seeing play out there? And what will we see, you think, be the trend in 2026?
Yeah. As we look at it across different regions, it's interesting. It speaks to the diversity in the cattle business. And I talk about this often. The average herd size across the United States for cow-calf operations is about 45 head. Nobody can make a living off of 45 head of beef cattle. It's just impossible. But it speaks to this business. We have ranchers that the only income they have as a family is the cattle business. A lot of those bigger ranches, particularly in the South and the Western United States. But then we have a lot of folks throughout the Central Plains and East where the cattle business is part of the other family operations. Maybe both spouses work jobs in town and run some cattle on the side. Maybe they're in the grain business, predominantly row crop farmers, but they run some cows because dad did it before them and granddad did before that. And it creates some uniquenesses in this business. I think it's part of the reason heifer retention hasn't been happening at a fever pitch, because a lot of these grain and oilseed guys are facing some pretty tough margins right now, and the cattle income's kind of holding things together. And so as we look at it regionally, some of our strongest prices, most robust markets are in the north right now. It's where we have a lot of our higher quality, bigger runs of cattle that lend themselves to higher price points, relatively speaking. But what's been fascinating in 2025 is we've also seen some narrowing of the spreads between the southern cattle, which usually are lower quality, and the north, because we've had that border shut off of Mexican imports of feeder cattle and calves due to New World screwworm. That's created a surge in demand for cattle from feed yards in that region of the country and other growers and grazing operations to try and find supply more domestically. It's been basically the net loss of probably 800,000 head of supply this year. That's essentially 2 weeks of fed cattle slaughter. And so as we look at this going forward, that's been a dynamic. That's been something we've had to wrestle with this year that's allowed some kind of recalibration of typical spreads. But overall, I think everybody's pretty happy, maybe outside the last 30 days, with the prices they've seen. Because even with the correction the last 30 days, it's been record high profits, lifetime profits for most cattle producers.
Lance, for cattle producers planning out the next year, 2 years, what's your biggest piece of advice or biggest factor you're going to be watching?
You know, I think the last 30 days put this in the forefront of producers, and I'll mention it and reinforce it here. We're at a place where throughout 2025, there were a lot of high fives and pats on the back and cheers because of how strong the cattle market was. What we need to remember is these markets are psychological, and there is an emotional component to markets. And when everybody's sitting out there and being their biggest cheerleaders, usually when the market has its most financial risk in it, we have the most to lose. Conversely, when everybody's panicking and selling and moving on from this market, is when you usually have the most opportunity, financially speaking. So here we are at these highs where we're still in kind of this euphoric, excited state in the cattle business. It means we got to manage our risk. And the cool thing is cattle producers have some tools available to them that they've not had before. USDA has their livestock risk protection program, their livestock gross margin programs that have some tools cattle producers can use, even if they're smaller operators. Investigate those programs. If they can participate in the futures and options markets or can put together truckload size lots of cattle, look into the video auction markets where you can sell in the summer for fall delivery. And just take some time to investigate the risk management tools that are around you to preserve some equity. You don't need to do all the cattle you're trying to sell, but even just a percentage to cover your fixed costs so that you can live to fight another day down the road.
Fantastic, Lance. Thank you so much for joining.
Thank you. Appreciate it.
We appreciate Lance's insight. Let's take a look at some fertilizer. The North American fertilizer market is on edge after President Trump threatened tariffs on Canadian fertilizers through details that are now still unclear. Markets are watching very closely as that impact would vary by product. Urea and phosphate imports from Canada would see little to no effect, while UAN and ammonia could see slight price increases. Potash, is where the U.S. relies on Canada for nearly 90% of the imports, could face the biggest hit, potentially raising spring input costs for farmers here. Globally, the markets are mixed. European nitrogen production is improving as natural gas prices drop, but old plants remain offline, keeping supply tight. Then Chinese phosphate exports are down for the year, though heavy shipments from June to October helped ease some of those prices temporarily. Overall, while tariffs and global supply shifts add uncertainty, farmers can't expect selective pressure on key fertilizers like potash and UAN heading into 2026. So big mixed bag. I wonder if it's the same for you on the grain market side of things.
Well, the soy complex certainly felt some pressure this week as they continue to deal with the uncertainty on biofuel demand and exports, which is pressuring soy oil in particular. The EPA is not expected to finalize the 26 and 27 biofuel blending mandates until the first quarter of 2026, keeping present some level of uncertainty for the near future as well. Cattle futures were also pressed by growing reports the U.S.-Mexico border could start to reopen in the very near future, possibly by the end of the calendar year. One positive report that came out this week was the Consumer Price Index for November that was better than expected. The CPI reading for November, which is the gauge that shows inflation, showed year-over-year cost increases of just 2.7%. So that indicates the Fed is maybe doing their job and getting things right here with the way they've been handling interest rate changes. So that's a quick look at where markets are for this year, Tanner. But this is our final show of the year.
That's right. Thank God. I mean, shoot. No, it's been a great season. We appreciate all of you listeners. Make sure to follow us on social media and have yourself a Merry Christmas.